Hi there, I'm Mark Sebastian, founder of OptionPit.com, and this is Earnings, the Option Pit method, trading stocks and options after earnings. You know, a lot of people spend a lot of time talking about earnings setups before earnings, right? Like, how do you trade before earnings? There is way more money, in my opinion, in trading after earnings than before. It's actually a lot easier and more certain. It's a little momentum based, but you can also figure some stuff out. For those of you that don't know me, this is me. I am handsome, as you can see. Not as handsome as most of you, but you know, I was a floor trader. I run for about a decade. I now run a hedge fund called Line Capital. That is a volatility-based hedge fund. I also run a company called Option Pit. We are an education and consulting company. We work with retail traders and teach them how to trade like professionals. That's what it comes down to. And then once we get you guys professional, we know how to work with you too. Our stuff, it goes from beginner to all the way to super advanced. So we enjoy what we do. So volatility can act like a headwind or a tailwind. All right. So we're going to talk about some basic buy-sell decisions. Real basic. We're going to talk about the analysis of expected stock movement ahead of earnings. We're going to analyze post-earnings vol moves, and then we'll look at a couple trades. All right, so has this ever happened to you? Mark, market makers are cheaters. I bought all these calls right before earnings. The stock is way higher, but I'm not making money. Market makers are taking my money. And the answer is no one is taking your money. All right, volatility changed. One of the inputs in the model that gave you your exposure changed. And this is, you know, while I normally use this example for kind of how volatility can affect things, this is also a really good example of why it can be such a crapshoot to trade before earnings. That's really one of the things is people love it, but it's a crapshoot. It's exciting, but it doesn't, for the most part, make people money. So what is volatility? Well, there are three main types, and we're just going to do a brief overview. There is realized vol, historical, and implied. Each one is useful in its own way. Let's just quickly talk about them. Realized vol, this is how much something is moving right now. So, you know, we had earnings last night. This is how much this underlying is moving on that. All right? It's a daily move. It's an immediate move. It's kind of what's happening right now. All right? You can look at it in terms of, you know, this for your chart people, you know, your candlestick people, your Fibonacci people. This is, they're really looking at realized volatility. All right? Because all moves end up being historical in nature. This is kind of what's happened the last couple of days. One decent one to kind of that I'll use is 10-day historical volatility. It's pretty whippy. It really just tells you what's happening kind of right now. You know, what events are happening. There's plenty to discuss. So there's 10. This is like an image of Google. All right, and you can see it moved on earnings. This is from I think last January. Then there's historical volatility, and this is how much underlying has moved in the past. It can be viewed in monthly increments or as long as a year. That piece tends to be a lot more mean reverting. 10-day volatility, not as much, but anything longer than that will have a strong mean reverting piece. So what I want you to notice, this is Goldman. Take a look. It's got huge movement in its 10-day. The 20-day, which is this light blue, you know, moves less. And then 60, notice the 60, it doesn't really do anything. Right, it's pretty flat. And all of these revert. But the more time you add, the flatter and less volatile these things will be. And then finally we have implied volatility. Implied volatility is how much the market is expecting the underlying to move. And it's based on the price of an option. It is an output of the pricing model, not an input. Okay, so basically, you can use indexes, you can use metastock, you can use live vol. There's all these different things that you can do. But basically what it is you take the option price, and then you take the 5 inputs that go into the model. So the 5 inputs are the price of the underlying, all right, timed expiration, strike price, cost to carry, and then forward volatility. But here's the problem. We don't know forward volatility, so we have to solve for it, which is where we get implied. So then we've got our question mark input. So then what we do, we move all this over there, run a bunch of fun linear algebra. All right, so, and then we solve for implied volatility. So it's actually the answer to a problem, not the input to a problem. I'm not sure what you mean, Richard. All right. So here is, what is carry? That's cost of carry. So that's how much it costs to borrow the stock versus how much you get in dividends. Yeah, sorry, you're right. That's a differential equation, not linear algebra. Thank you for the thank you for the correction, Rick. You are correct. But anyway, you can see VX, and that's Black-Scholes. There are other models. There are all sorts of weird models. But they all kind of use those 5 factors. So VXGS is the VIX of Goldman Sachs. And what I want you to notice is that it has, take a look at the 200-day moving average. That's the 200-day moving average. Could that get any flatter? Short answer, it would be tough. And then the red line is the 50 days. So you can actually see that there is the mean reversion in volatility. VXGS is the VIX of Goldman Sachs, for those of you who don't know. So what I want you to notice is how reverting VIX, that implied volatility is. Whereas some of the other ones, there's still some movement even. There's like nothing to Goldman. It is flat as a pancake. So that mean reversion is important, right? So theoretically, you want to sell here and buy here, right? Maybe. But, you know, in theory, yes. So the big thing about implied volatility is that over the long term, we know where it will go. It will revert. It is mean reverting. So like I said, Goldman, the stock, this is an old picture, but Goldman, the stock, no reversion. Goldman, the VIX index, reversion. It's right about 28%. All right, the other thing I want you to notice is that to keep this 200-day moving average flat, what you end up with is a lot of prints below the 200-day moving average and some ones that get really far away on the upside. So just remember, a stock can go anywhere and stay there. Volatility can go anywhere, but it can't stay there. It has to revert back. So that will help you with your buy and sell decisions. Right? When vol is low, you want to buy. When vol is high, you want to sell. So now, let's talk about analyzing earnings. right? And I want everyone just have an understanding of what volatility is. So do we have any questions? How do I feel about digital currency? That is an entirely different webinar. All right. So the key to understanding earnings, both before and after, is the straddle price. The straddle price is the price of the at-the-money call plus the price of the at-the-money put. Stock trading 60, what is the cost of the 60 call plus the 60 put? The straddle, and it's the market's best guess at how much the underlying is going to move between now and expiration. It's about 80% of a standard deviation. It really does represent pretty close to kind of the 50-50. It's about a 58-42. So the straddle is going to be overpriced 58% of the time, or and underpriced 42. All right, but remember that doesn't include that how much it's overpriced by or underpriced by. So don't take that 58 to 42 to mean kind of how the payout works, because it doesn't work that way. What is the definition of volatility? You just brought up a differential equation. Now you want to know the definition of volatility. So the definition of volatility is going to be how much an underlying instrument is going to move over a time series. Different Rick, okay. It's how much an underlying is going to move over a set of data, up or down, regardless of direction. So it's how much we expect something to move, regardless of direction, over a series. Yeah, it's kind of how much it could move. All right. And so for stocks, it's really annualized over a year. How much do we expect the underlying to move? Ask me that at the end, John. All right, so a year from now, so the VIX is trading 10. All right, so that means on an annualized basis, we're expecting the S&P 500 to move 10% or less most of the time. That is what volatility means. All right, that is what. So if the S&P was 100, it would be looking for movement in the next year of 10. All right, so the thing to remember about the at-the-money straddle price of a weekly option, of any option, of a weekly option, is that it's going to give us the market's best guess of how much the underlying might move. It's rarely dead on, but over time, its average price is usually pretty accurate. So earnings straddles miss a lot. You know, they're never dead on. But over time, they end up being pretty fairly priced. You know, my friend Russell Rhodes did a big study on earnings straddles. Yes. Ask me that at the end. So my friend Russell Rhodes did a study on earnings, and what he found was that if you bought options, you lost, and if you sold options, you lost on earnings over time. And the amount you lost was essentially the bid-ask spread. So earnings are fairly priced. Anybody that tells you there's a ton of edge in earnings, you've got to be very aware of what you're trading, and there's not a ton over time. So here's a weekly straddle. This is Lulu. They announced today. Okay? And this weekly straddle does a really decent job of kind of guessing how much we might move. So Lulu at the close of business was trading 57.5. The 57.5 straddle right here. All right. So the weekly, it does do a decent job of guessing. However, when it's wrong, it tends to be really wrong. So let's do some earnings analysis here. So they were in Lulu looking for about a $6.20, $6.25 move. Call it about 12%. This is important. All right, let's see how much it actually moved. I haven't looked at Lulu in a while. So you can see they were looking for a $6 move, and at the close of after hours trading, the last print was $60.89. So it vastly underperformed the straddle. It only moved about $3, so only about 5%, and we were looking for 12. So now this is where after earnings trading comes into play, right? How many people have heard, how many people have traded before earnings and gotten burned? Yeah, why did you get burned? So I'm getting a lot of yeses. All right, and the answer is, why did you get burned? Young, naive. Sometimes the stock moved big. Stock made a 3 standard move. Move wasn't big enough. Naivete. Good answer. So would it be fair to pick the direction was wrong? So would it be fair to kind of wrap it up like this? The reason why you lost money is because you traded on something that was borderline a completely unknown. Right? Right. All right. Now, if you look at it, when you look at stock analysts or anything like that, when you're analyzing a stock, would you ever just buy a stock completely unknown? Would you ever do a binary event, right? Would you ever bet $5,000 on a coin flip? I'm seeing a lot of no's there, right? Well, when you trade before earnings, when you trade before earnings, you are essentially doing a coin flip. Now, I will tell you, there are certain times that I trade earnings, but only when I'm very, very certain of that but I trade from a volatility perspective, not from a pricing perspective, and I do it, I would say, so I am what they would define as a professional trader, and I trade ahead of earnings probably a total of 4 times a year. And I mean 4 trades a year. So that's because they're such a crapshoot. That said, trading after earnings is awesome. I love trading after earnings. So now, let's do some analysis. All right, so the next question, so the earnings moved. All right, so now the question is, did the stock exceed or disappoint the straddle? That's because I'm moving around. All right, did the stock exceed? I get excited. I don't know. I'm Italian, so I start moving around when I get excited. Does that make sense? Like if you guys saw me right now, my hands are flailing. Yeah. So did the stock exceed or disappoint the straddle? Lulu disappointed for sure. And so depending on the severity, all right, of the move and then the change in volatility, that is going to help you determine whether to go with the momentum or trade it counter. All right, so scenarios. Straddle outperformance. What is the stock doing? What is IV doing? These are the questions you're going to ask yourself. Straddle underperformance. What is the stock doing? What is the IV doing? Every time. So straddle outperformance. All right, if the stock is up a lot and IV is not in very much, the stock is going to keep going. All right, that is a sign that traders are chasing calls. Right? Why does IV hold up on a big up move? And this is really for any major move. Why does IV hold up when a stock's rallying? Why did we get earnings? There's supposed to be a vol crush. Volatility is going to come in somewhat, but let's say it doesn't get to kind of where it would normally be after earnings. Yeah, what do you mean by not much? We'll talk about that. So, stocks have this pattern on earnings. All right, here, let me pull up a chart We'll just look. I mean, we can look at which one I'm not talking about. Let's look at Facebook. So let's take a look at the volatility chart of Facebook. Nope, wrong one. And what I want you to notice, look at a year. You get a big vol bid, and then vol drops. You get a big vol bid, and then vol drops. All right, but the severity of the drop can be different. So what I want you to notice is that the severity of the bid was different, severity of the drop was different. Here, one in particular. Vol did not get bid up very much, so the straddle was not that expensive. And guess what? Facebook didn't do anything. All right. So what does that tell me? We're going to talk about it. So part of that is about knowing the stock and knowing. How can I say Lululemon? Why don't I wait till morning? I am going to wait till morning, but what I'm saying is in after hours it underperformed. Can we all agree on that? Let's put it this way. If I owned a straddle, I would not be happy right now. That's an easy way to say it underperformed. Right? If you own a straddle in Lululemon, it's kind of like the look my wife gets me when I come home from work. Oh, you? Kidding. She's awesome. Not in the room. So let's take a look at Apple. Here's one where the straddle clearly outperformed. All right, they had bid it up into earnings, but it completely popped. And what I also want you to notice is that, take a look at that vol chart down there. It didn't immediately drop. So let's talk about straddle outperformance. If the stock is down a lot, so let's start here. So if the stock is up a lot and IV is not in much, the stock is going to keep going as traders are chasing calls. You'll get a little bit of kind of this, when they hold vol up, I got myself distracted. When they hold vol up like this, what you're going to see is the stock pop, pull back, and then take off. It's going to look like kind of like a back spread. So you see the stock pop, drop. All right, so it'll pop, drop, and then roll. And you got yourself a nice little run that you can trade. That's kind of the funness of that trade. So if you look at Apple, we can just pull this up. So let's look at the prices for the Apple 4s or the Apple 11s. So notice they just crushed vol, but not as much as you might have expected, right? Like, my point is that this is still expensive, relatively speaking. You see that? In fact, the vol held up the whole time. That tells me it's going to keep moving. So here we are, we're up 7. Next day we're down $1.50. Here's where you step in. You know, you can either buy probably I like to go with the week out, the next week. Either buy the stock or buy the 155 calls for $1.80. How are those 11s looking now? You're happy. The typical drop is it is literally up one day. People take a little money off the table, so it drops, and then it runs. And then the smart money moves in. You know, how do you decide? I think you have to kind of visually inspect it. So, like, take a look here. Yes, volatility came in, but it's not cheap on any level. Then you get your drop, and then it was off to the races. Now, don't get greedy, because you can see we did get another drop here. Don't get greedy, but take the money and run. So now, if the stock is down a lot and IV is so generally speaking, my point is that if the underlying rallies and the straddle outperformed and volatility doesn't get a lot cheaper, there's going to be a follow-through move. You might have to wait a day, but there'll be a follow-through move. Don't jump in that day. I mean, you can jump in that day. You'll eventually win. But give it a day and then buy calls. That's kind of the way I do it. All right, so now if the stock is down a lot and the IV is not in much, the stock is going to keep going as traders are chasing puts to set up hedges, but it's a lot more confusing on the downside. All right, because there can be, if people are hedging, that means they still like the stock. So you're going to be a lot less certain on rally. You're a lot more certain on rallies than you are on sell-offs. Sell-offs to me are a bit of a crapshoot. So like take for instance Action Alerts Plus. Advanced Auto Parts, right, gets murdered on earnings. They hold vol up, right? And then it's been rally ho. Well, what was going on? People were hedging. They wanted to stay long, and they were hedging. So, believe it or not, I find that non-directional trades like long at the money butterflies, you know, long the meat, long the thorax, short the wings, butterflies, are more effective when the underlying drops and vol holds up, because skew is going to get really, really big. It is not one where I want to pick a direction. Does that make sense? Good. So, outperformance and down and vol stays high, you don't play the momentum. Vol stays high on a rally, play the momentum. All right, so now let's take a look at Campbell's Soup. Campbell's Soup's earnings were Not good. Not good. Not good. Campbell Soup's earnings were not good. Campbell Soup's earnings were not good. So what I want you to notice is the straddle price here, though. You got $1.60 and $1.40, so $3.10. 7.5%, 7%. Well, what did Campbell Soup do? Completely outperformed. Volatility remaining kind of high, right? Take a look. All right, so that's one where I think that I want to continue to. That's one where I want to be long vol, but I don't necessarily want it to pick a direction. All right, so now what if IV is crushed? So what if it outperforms and they kill vol? The answer is buy the direction. If a stock pops and IV gets murdered, it denotes excessive call selling. So when excessive call selling means there's tons of call overriders. So then if the stock gets a little bit of a bid, what's going to happen to those call overriders? What are they going to have to do? What do? They have to cover. So they either buy the stock or they have to buy their calls. What does that do? That pushes the stock higher. You'll get this call overriders are people along the stock and sell calls. So a stock's up and then they sell a call against it. So the problem is if I sell a call in let's say Apple. All right, so let's say I sell a call. All right, so I sell an Apple 160 call, and then Apple starts to go through that call strike price. What's going to happen? I have to buy the stock in order to not have a big tax problem. All right, the shortcut. So you have this race to cover. All right. So if the stock now, so you're naked. No, you're not naked. You're long the stock and you short a call. That's an overwrite. So someone just commented, this is way too complicated for me. Well, if it's way too complicated for you, and this is generally kind of a basic webinar, you probably shouldn't be trading options. And certainly not around earnings. So if the stock then, so short covering is basically you sell calls. Here, I'll show you what a short cover is. We'll bring it back a notch. So here's Apple. So if I'm going to make sure I don't have any positions. I don't. All right, good. So if I buy 100 shares of Apple, and then I go to September, and I sell a 165 call, I've now set up an overwrite. Long stock, short call. Basically a covered call. So if this now, so I like buying calls when volatility gets destroyed on a winner, on an outperformer. I love it, in fact. Now, if the stock tanks and IV gets murdered, so if they kill vol and the stock tanks, that means people are not hedging, they're just selling the stock. You want to buy puts. IBM, is the classic. Every time IBM gets killed, they kill the vol, and you just want to buy puts. You want to own premium. Here's another one. Died, kill the vol, buy puts. It's like, it's been clockwork with IBM lately. All right, so now what if the straddle underperforms? If the straddle underperforms on earnings, the stock is likely to see its implied volatility get owned. However, here's the one thing we know. Long term, the underlying will move in the direction of the earnings. So over the next couple of weeks, when I do covered calls, folks should buy the stocks as they run away from me. Yeah, that's what happens a lot. All right, so here's an example of Google, right? Google has had a couple of times where it's consistently, here's one where it outperformed, and they creamed vol, and it went higher. Here's one where it dropped, did not move as much as the straddle was predicting. Underperformed the straddle. So what do? You just buy puts. And it kept going. So when a stock underperforms, and it really, regardless of the volatility, the direction it moves tends to be the right direction. Very rarely does it revert back. Here's Alibaba. Consistently underperforms on its straddle, but consistently the path the straddle takes is the correct path. You just, wait the day, see where it ends up the day after earnings, and then go with it. All right, so let's pick a stock or two that had recent earnings, and we'll set up a directional trade or two. Does anybody have any stocks that had earnings in the last week that they want to play with? Come on, guys. Ulta Cosmetics, DG, Boeing. All right, so let's look at all three of them. So let's look at Ulta. Ulta had earnings on the 24th. All right, so let's take a look. So here we are, Ulta trading 233. The 232, well, you really want to look at kind of the strangle, but the straddle about 20 bucks, $18. Let's say 19 bucks. It moved 21. All right. It moved 21, and the vol stayed bid. All right, so what does that tell me? Well, you got a day of fall. In this case, you had a day of follow through, right? Close to 212, then 207, and has now just been off to the races. This is where owning that and the vol's still coming in. So I'll tell you what I would do with Ulta. I'm going to find the cheapest option on the board, which is the October 13th weekly or the September 29th. One of those two. I'm going to buy the strangle, the October 13th 220, 222.5 strangle. That's going to be $14.50. And here's the beauty. Look how much I can get out of like some stuff that's pretty wide out. If I go 12.5 bucks away, $8.80 for this little butterfly trade, I really like. It moves $7 today, and I can get over a month of exposure right? A month and 13 days of exposure to movement for $8.80. And that's because skew is steep and at the money vol is cheap. That is the trade I would set up if I was going to trade an Alta. What do you think, Mark? The other Mark. All right, so now let's look at Dollar General. Dollar General had earnings this morning. So let's see where it was yesterday. Here's Thursday. All right, 76.73. So we're going to basically, what do you think? It's interesting, right? I'm a life changer. So you've got I would look at I'm going to look at the 76.5, 77 strangle expiring September 1, and that's 240 and 220. So they're looking for a $4.60 move. So, this guy was down today as much as $6. So I would actually chalk this to a kind of an outperform day. Now here's the interesting piece. I'm going to go out on a limb and say they basically kind of just destroyed the volatility. I want to wait one more day because I think it might get down to here, but I think they murdered the vol. So you know what I probably would bet on if I was going to do this trade, if I was, just in a theoretical place, I'd go out to November, or I'd probably go to October, and I would buy the 70 put for $1.60. I may do that. Don't understand murder of the vol. So this red line is implied volatility, and it went from 34 to 24, and is now below where implied volatility was before earnings started to come into the picture. So take a look. It's right back to normal, maybe even a little low, relative to this area right here. This is the part I care about. When you look at this, and then look at where the implied volatility is. Do you see how it's kind of cheap? So I think that Dollar General is going to keep going lower. I think it's going to be $68. I think we're heading back into this range. $69. Might test lows. All right, I'll do one more. Boeing. So Boeing just has crushed it. And I mean, they took the vol down to about normal levels. If you stepped in and bought a call, you had a day or two of winning, but it's kind of done nothing. If you bought your call here, day 2, you probably were a winner. When it was up 7. Yeah, I know. Been flat since. Sometimes, here's the one thing I will say. When stocks make it's one thing to outperform, it's another thing to just go parabolic. And so when you get this, you basically, when it moves $7 the next day, you missed your chance. They basically took a month of trading and shoved it into one day. But right now, as I look at it, I don't know when earnings are. I think, here's what I'll say is vol's kind of high, but it's far enough away from earnings that, I would have analyzed this entirely different than a post-earnings play. All right, so in summary, volatility reverts, implied volatility forms positions. Understanding the straddle is key, and watch the post-IV move and straddle performance. All right, so we have a course coming up on September 14th. It's going to be a 3-hour class on directional trading. So if you think you learned something today that you're going to be able to trade, here's what I'll tell you. Every day in my chat room, I make it a point to try and pay for the entire month's subscription. And so we are developing a new class for 2 weeks from today, professional approaches to directional option trading. It's going to be for a relatively new investor all the way to intermediate. We're going to charge $297 in our store when it becomes available. But for now, it's going to be $197. And if you use code 25_off and the capitals count, you have to keep the capitals. You'll take an extra $25 off, and that's through Sunday. And you're going to be using I'm going to teach you how to be long calls, long puts, long call spreads, short call spreads, long put spreads, short put spreads, butterflies, calendars, all of the above. We're going to be covering that. This course will pay for itself. I would throw in that while you can pay $197. These courses are free for active Option Pit Live members. So if you pay the $125 a month, you actually get the course for free. But we only do 10 of these a year, 10 or 11 a year. So real easy, optionpit.com/direction. Get yourself signed up, and tell you what, if you sign up by tomorrow, I will throw in my trading debit and credit spreads course for free. But you have to sign up by tomorrow. Earnings-based situation. I have a nagging question. 16 delta on a call and put side is equal to 1 standard deviation and a 32 probability that you will be between those two strikes. No. A 68% probability that you will be between those two prices. Yeah, it's a 32% probability that you'd be outside of that, give or take. That's a rough equivalent. It's not mathematically exact, but it's about 32% chance that you end up outside of your straddle. So this is going to be an awesome course. I would encourage everybody to take it. If you sign up and you hate it, I will give you your money back. Or if you sign up and it's too advanced for you, that's usually what I get more is, Mark, this was really good, but I couldn't understand it. Or it was a little advanced for me. This one will not be. This is going to be for beginner through intermediate traders. But you're going to learn all sorts of things that professionals do all the time. All the little tricks of the trade that I started to cover here. Go to optionpit.com/direction. Yes, that's correct, John. His question was 68% that it ends up out of the money. Right, and 32% that ends up in the money. I guess that's correct, yes. Any other questions? But this is going to be a crazily good course. Will we have a way to quantify what is pulled in? Not quite sure. What do you mean? Yeah, this one is going to be a little more. You'll come away with a trade or two that you're going to want to do. And I'm going to teach you a couple ways to be right and wrong, to win even if you're wrong. Will the course be recorded? Yes, you can. We'll record it multiple times. Or we will record it. You will have access to it for life. You said someone there, if you are a member of Option Pit Live, so you get you join our chat room for $125 a month, then these courses are included. Will the course be, is this live or on demand? It's live. It's a live class. And what was that about free? Oh, if you take the course and you don't like it, yeah, it's $125 a month. If you take the course and you don't like it, we're always happy to refund your money and just, you won't have access to it anymore. But yes, this does include the 125 is Option Pit Live. Here I can. Yeah, it's pretty awesome. So it includes Option Pit Live includes a daily strategy letter where we put out kind of trade ideas that we like. It includes our chat room where people sit around and chat all day. I do a daily chat wrap. It's a 3 to 8 minute video where I go through the 3 best ideas that I have. And I can tell you, if you trade my trade ideas, I generally pay for Option Pit Live every day. And it also includes the Saturday classes, or in this case, Thursday night classes. The live course is going to be on September 14th. I should have put that on here. What is the gold membership? The gold membership is the next level up, and if you're serious about learning, my gold membership is $1,500. It is the same. It is better than what most of my competitors charge $6,000 for. It is a modular 12-part, 15-hour course. It comes with all of our Saturday class archive. So every Saturday class that we've ever done, and we've done 30 of them, or not 30, we've done 25 of them, you get 4 months of access to our chat room. We do a special live open mic night where you can ask one of our mentors anything you want for an hour on Mondays. And then we do a live trading lab on Thursdays. It also includes one-on-one mentoring course with me. One-on-one mentoring session with me. Not a bad deal for $1,500. And I would strongly suggest that is as like the premium. Like if you're not taking that, if you are serious about becoming an option trader, you're going to want to take that course. It's the best. And if you got questions about that, you can call me or email me. If you want to talk, I can set up time with me, or my salesperson. And my number is, my email is mark@optionpit.com, or you can email me, or you can call the 800 number, and Leisha, my director of operations, will arrange for us to get together. All right, so like I said, take the live class, get debits and credits for free, use the code. But if you really, is live all free? It is if you open up a brokerage account with Lightspeed. So I have a brokerage account. Lightspeed. I'm going to stop the recording here.